So the market has been all over the place, but when it does drop, it gives us an opportunity to buy more. So exactly what's going to happen in the market, we won't know, but I like taking these opportunities. I have been purchasing a few stocks, and today we're going to talk about 4, one of which I own and 3 of which I'm really debating on buying right now at these prices. So they're all higher yielding. They all pay monthly dividends, which I love. We have 2 REITs, 1 BDC, and 1 ETF. And I've only talked about one of them before on the channel. So it's new to me, and let me know what you guys think if you like this type of content. Leave a comment, let me know, like and subscribe if you are interested and you want to know more about the monthly dividends that I love to get, and even some weekly stuff that I've been working on with some weekly dividend funds that are relatively new in the market. So if you're interested in anything like that, stock market related stuff, don't forget to subscribe, and let's go ahead and jump straight into our first choice. I'm starting off really strong with EPR Properties. This is an experiential property, and let me tell you why I like this one so much. It is down heavily the past 5 years, and we can note that this was during the pandemic, which is why it dropped. It has not returned to pre-pandemic levels. There's still a lot of fear in the markets, and with interest rates going so insane, these REITs have not been able to catch a break. But in my opinion, with the interest rates coming back down, I think that there's some really good potential for this to do well. And we have seen it bounce a little bit in the past 6 months, up just 1%. The dividend yield is 8%, which I think is pretty good. Of course, you know, the S&P 500 typically returns 8 to 10%. So if you get an 8% dividend from this and it can yield 2%, then you're matching the S&P 500 and you're getting those dividends every single month. Now, when it comes to EPR Properties, the reason why I like this one so much, we'll jump into their website, is because the experiential portion of this. So the portfolio, what they have, I think is really interesting, and I think it has a really solid future. So total investments is $6.8 billion, 354 locations, and 200 plus tenants in 44 states and in Canada. Now we can see they have everything under the sun. They have movie theaters, which I don't like. They have eat and play, things like Topgolf, skiing. This looks like some water attractions, water parks and stuff, experiential lodging, gaming. Gaming is a huge one. This is going to be more gambling, not necessarily like video games, but gambling is huge. It's always been huge, and I think it always will be huge. Cultural and fitness and wellness. So the reason that I think this fund could do well, one, the website's beautiful. They do a really good job with it, and I like that it brings investors in. But I think it's super important to think about where we're going to be 20 to 30 years from now. With how people are putting everything on the internet. We have TikTok, we have YouTube, we have Instagram, even Facebook. People are traveling more. But the key thing with this is vlogging. People are vlogging more, and I know you're probably thinking there's not enough vloggers to make a huge difference in this market, and I would agree. But people that are watching these vlogs, if people are going to these attractions saying, look how fun they are, which typically people do, you want both ends of the spectrum, either a really good trip or a really bad trip, it's going to bring more people's eyes to these kinds of things. And so that's why I think Vici Properties is another one like EPR, that I am very hopeful for with where I think the future of these markets is going. Now, key thing with EPR, it has an 8% yield. So let's take a look at the dividend and see how it has been holding up in these rough markets. So we can see I always use Seeking Alpha. I hope you guys like Seeking Alpha. It is one of my favorites just because everything's very straightforward. Their last dividend was 29 cents, which again is monthly, and I do own this one, so I get this dividend, which I love. The forward dividend yield is just under 8%, and the annual payout is $3.42. The payout ratio is very low, which is 70%, which I really like because this is, again, more higher risk when it comes to just the type of REIT that this is. So I think that a low payout ratio is great. When we look at the dividend history, we can see they did cut their dividend completely during the pandemic, and it was at 38 cents, and they've already grown it all the way back to 29 cents. But in order for them to reach that point, which they were growing it phenomenally before the pandemic, and that's why this thing is risky. But before the pandemic, look how well they were doing consistent growth, and they've already gotten back on track with that consistent growth. And we can actually see the dividend growth rates, which is really important. Like I said, they've only had, 1 year of dividend growth. If you go to the CAGR for the compound annual growth rate for 5 years, still negative because they had cut it during COVID, but the 3 year is 140% growth, which is just insane. Now that's not 140% dividend. That's just them growing the dividend because they've gone from 29 or from 0 all the way up to 29 cents. I'm not sure how all those numbers really interact, but still very, very impressive. They do have a good growth rate. They're already up 4 cents just over the past 3 or 4 years. So this definitely is one that I'm looking at purchasing more of. Like I said, the price has fallen a little bit. It's trading a little bit sideways, but I think the potential here is insane. The next one is one I've never talked about on the channel, and it has some crazy, crazy potential. This is a BDC. So let's jump straight into it. This fund has been doing phenomenal. I should say stock. This stock, Capital Southwest Corporation, this BDC is up 7% the past year and has a 10.5% dividend yield. 10.5%. So with just the dividend, if they can keep that up, you're already outperforming what SPY typically does. Now, over the last 5 years, they're only up 7.3%. So they've really done well in the near future. But the last month, they are down almost 12%, which is a little bit scary. Of course, the market has been rocky. We've seen a ton of stocks dipping like this, but with that strong dividend yield, this one has so much room to where the price can trade sideways and you're still having a phenomenal, phenomenal return. Let's take a look at their website and get more information on how this BDC operates. Looking at Capital Southwest Corporation's, their investor presentation, there's so much information in here. I'm not going to bore you guys with it too much. Go check it out for yourself if you want to read all the fine little details. One key thing is management. This is an internally managed company, meaning that these guys are the ones making the deals. They're finding the companies that they want to give their money for investments. They're going to loan this money out. They're going to make money off of it being loaned out. And as long as the companies are able to return the capital and hopefully do well, this company will do extremely well. So management is extremely, extremely important. We can see that they all have 20 years of financial treasury and BDC experience, which we love to see. You love having strong leaders for these kinds of companies. Now, they were formed in 1961 and were regulated as a BDC in 1988. So pretty phenomenal. They have some solid history, 32 employees. It's definitely smaller. This is not a type of company that you need a ton of employees for. So if you're thinking, oh, this is way too small for me, it only has 32. This is not like a production type company. They're not making anything. They don't need all these people to constantly be working. They are fine with smaller numbers to just loan out this capital, regulate everything, track everything, and find new investments that can make the company more money. So again, there's tons of information. I want to jump to some of their charts, and we can see the record of consistent dividends continue. They have some supplemental dividends and special dividends that were paid in 2022, but again, they're not super consistent with the dividends. I think this one has some really, really strong potential, and we can see it's paying out. This one it does pay out quarterly, so I was wrong about this one being a monthly dividend payer, but even quarterly, I think this one has a ton of potential, and we can see the dividends. The regular dividend per share has been growing from 44 cents to its current 58 cents. We're going to track that dividend growth on seekingalpha.com, and we can see the history of value creation. The net asset value per share. This is really, really important when you're looking at NAVs. You do not want a decaying NAV. Now, their NAV has gone down since 2015, which is a bit of a bummer, but we've seen that the dividends have been increasing and the regular, both the cumulative and supplemental and the cumulative regular. So the special dividends have been increasing and the regular have been increasing. And so they're keeping this NAV right around 16. It's not decreasing since that 2020, we had a crazy hit in the market. They've been able to uphold this NAV and keep it consistently around the 16 mark, which I think is really, really important. And again, there's so much more information on here. One thing that's really important is if you don't know much about BDCs, you want first lien debt. So first lien is more important. It's better than second lien because when a company goes under first lien, they're paid first. That's why it's called first lien. It's less risky. And so when you have first lien, they do have some second lien. When you have first lien, it's just a better overall security for the company. So again, there's tons of stuff on their chart. You can see so much information, and then you can also see exactly where all the money is going. Healthcare, media and marketing, which I think is huge. Food and agriculture, consumer products, and look how well balanced this thing is. It's beautiful, except they're almost to 90% first lien, and then a bunch in equity. So again, I really, really like this. I think they have a strong sheet, a strong rap sheet. They have some strong leadership, and that's huge for me in every aspect of investing. So Seeking Alpha, we can see the forward dividend yield is 10.7%, which is phenomenal. Their last dividend payout was 58 cents, which we did see on the website as well. Payout ratio a little bit higher at 80, almost 85%, but we can live with that. 5-year growth rate is solid at 9%, and dividend growth is only 1 year. What I do want to mention, I was wrong. This one definitely is a quarterly dividend payer. but I think it has so much potential, guys. There's so many stocks out there that I don't love, and this one I can definitely see myself getting behind. Consecutive years of dividend payments is 7 years. So if we go to the 10-year mark, they definitely have not been paying out consistent dividends for long, but the growth is there. So if we scroll down, we can see all these quarterly dividend payments as well as some of these special payments. Look at all these special dividends. It's insane. They continue to pay out these high special dividends, and that's what makes these spikes, because this special dividend was 50 cents. It was more than the regular dividend. This dividend, the regular dividend was $1.25 and the special was 85 cents. So the dividends here are phenomenal, and I love special dividends. This is probably one of the more solid special dividend paying companies that I've seen, that in Main Street Capital. So all in all, a company that I like, solid dividend yield, and it's definitely one that I will be looking to invest in the near future. Our next, this is another REIT. This is LTC Properties. The next one on our list has a little bit of a lower yield, about 6.35%, but some really solid potential. And I'll tell you why I like this one. It's different than any other REIT that I own. And so on top of everything that goes into these REITs and how the market's going to affect them and how lowering interest rates could really, really help them, this gives me some more diversification. And so when it comes to this one owns, it's similar to Medical Properties Trust, but they specialize more in the senior assisted living side, which I think has insane potential. People are living long. This is another one. Think about the future. People are able to live longer with our modern medicine. They're able to do more as they're older. But again, they don't always want to live on their own, and some of them can't. So the medical technology that we have and being able to extend people's lives. And now when you're extending someone's life, you're not necessarily keeping them playing sports and getting on their roof to clean out the gutters. You're just making the last couple of years drawn out a little bit longer in a lot of cases. Now that's just my speculation, but that's why I think this one has a ton of potential, and it's in a different sector than what we normally see REITs in. And with that being said, let's check out their website. So we can see the LTC REIT. I'm in the portfolio portion. We're not going to look at their numbers because there's just so much information I want to talk about on the portfolio page. Now we can see the assisted living facilities are 115. It's definitely a little bit smaller, makes up 51% of the portfolio. And then the rest, 39% is skilled nursing, and then a few others. So total property is just under 200. Definitely smaller, but really well versed all over the US. What I love to see is I love these being in Texas and Florida, where we have just more retirees typically. But they're pretty much all over the place. I wouldn't say it's bad that they're in other areas, because that could mean that they're looking at markets that are less sought after and that there's less competition. But they do have all these featured properties, and I mean, they're beautiful. They're not going to show any ugly ones on here, but it is nice knowing that they have some high-end properties. And then we've seen some of these names before with MPW. We have Prestige Healthcare, ALG Senior Living, HGM Healthcare, so many other ones, pretty well diverse, and all others make up 31%, meaning there's so many companies that are using this REIT and using their facilities. And the interesting thing with these REITs, they can be tough, because if one company goes out of business, it can be hard to fill some of these spots. But that being said, if you're able to capitalize on the market and you think this is an expansive market that we could see as the average age is going up and the lifespan is going up, I think this one is another kind of a home run option. So for me, I think it's a really, really interesting one. I'm going to be doing some more research on it. It is a little bit of a lower yielding one, so I'm not diving in completely, but it does pay monthly, which I love. So let's take a look at that dividend history. So Seeking Alpha gives them a 6.34% forward yield. Their last dividend was 19 cents, because it does make a bit of a difference, about a 5% difference roughly. And the payout ratio is 85%, which I think is decent. Again, once you get into the 95s, I get really anxious, but 85, if they can keep it at that, that'd be great. Lower growth rate of 3.71%. So they're not even growing the dividend by 1% a year, which is a bit of a bummer, but it is a lower yielding fund. So they give the idea of it being relatively safe. Now, we can't say that for sure, but we can see by these dividend histories, it has been pretty phenomenal since they switched to paying monthly, where they started at 5 cents. Sorry, they started at 11 cents monthly, and now we're all the way up to 19. But that was over a long time span, and we can see if we go to the last 10 years, they have not grown the dividend since 2016. Maybe they've grown it a little bit. No, they've been trading it at 19 cents for a long time. Now, What does this mean when we're looking at interest rates going down? This could give them more potential to either refinance on their properties that are potentially higher interest rates, or if they have not been expanding and buying more properties, they may be able to do that and capitalize on these lower rates. It all depends on all their financials and their cash on hand and what the company is trying to do. So let me know what you guys think. I had not heard of LTC until a little bit ago. Maybe I have heard of it, but I never really looked into it. I think there's some really good potential here. I want to compare this one to like ADC and see if the growth that's lacking here may be better with ADC, but this one might be more consistent. Either way, let me know what you guys think. Let's get into the final fund, which is the ETF, and it is definitely one of my favorites, and I'm probably going to be buying it very, very soon. Ticker UTG, the Reeves Utility Income Fund, is easily one of the most consistent dividends I've seen for a while. And what's key with this is utilities have been going insane, and they're speculating that they will continue to go insane for a while. We had that run where natural gas was going crazy and now utilities. So I do think there is more time for these to do well, but we can see over the past 5 years, they are down almost 22%. So there's a lot that goes into this drop, but if we look at the max chart, this thing was high. It was over $37. So from the peak, it's still down over about 25%, but from the bottom, it's already up 20%. So I do think this one has some bounce back potential and some growth potential, which they say themselves that that's what they're striving for, is some great dividends with some tax breaks, which some better tax dividends, meaning you pay less on the dividends that you're making, as well as just some overall growth over time. That's all on the website. Let's jump into that and talk about this one. I think it's got great potential. And again, a high yield of 8.6%. You really can't beat dividend yields, on top of the fact that all time it's up 62%. So 62% plus all these dividends over these years is just crazy to think about. 20 years, wild. So let's jump back to that website. First thing I wanted to show you with UTG is the front runner on their website. They love distributions. They love dividends. Since the fund's inception in February of 2004, shareholders have received more than $1.4 billion in cash distributions. So, I mean, that's an insane amount. Let's check into their fact sheet from this quarter. So we can see they again have that stat up here because they really, really like showing that off. And they say right here, it intends to invest 80% of its total assets in dividend-paying common and preferred stocks and debt instruments of companies within the utility industry. So the way this ETF works is they're going to own REITs, utilities. They're going to own so many things. I was looking through when I was doing research on this and seeing what they own. They own AMT, American Tower, and they also own Crown Castle, two REITs that own and operate all of these towers that we use for our cell phones, which is just phenomenal. There's a bunch of other ones on there, a bunch of energy companies, which makes up a huge amount. So when it comes to this, it's very, very diversified. This ETF is very, very diversified, but at the same time, it is in this sector that I think has all these mini sectors that could do so well. I think the tower sectors, those REITs are going to do really well. I own Crown Castle. I've done videos on it because it is one of my favorites. There's a bunch of other ones, very popular names on there. And again, it is pretty diversified, primarily in utilities, which it's a utility fund, so I'm not surprised by that. And then you have communication, industrial, energy, real estate, materials, and cash. So there's a ton. You can see Talent Energy, Constellation Energy, tons of things that you can look at on the website. Go check it out for yourself. I do want to note the performance. Quarter to date is 3.4%, year to date 5.84%, 1 year is 8, 3 years is 0.2, 5 years is 1.1, and 10 years is 6.2. But since inception, 9.03, and the NAV follows that as well. The NAV has been doing pretty well. Now, the most important thing, let's check out the dividend history of this fund and see if this one is worth owning. Funny enough, this one paid out 19 cents as well, just like our last dividend fund that we were talking about, or dividend stock, I should say. Dividend yield just under 8%, which is roughly what they say it is. Annual payout of $2.28. 5-year growth rate is low, again, at 2.15%, but you're getting a solid dividend, and it's relatively safe. If we jump to the dividend growth, we can see the growth over the last couple of years. they only have since 2022, which is really, really interesting. This one looks vastly different than some of the other ones I've looked at, maybe because it is an ETF. But end year yield 9%. It has come up a little bit in 2022. I'm curious as to what the last couple of years have been, especially 2023. But when we look at this dividend history, you go to the max, we can see they have paid out some special dividends that were insanely high in 2016. And we haven't seen those necessarily in the recent past. But you never know. You never know what could happen. And we can see the dividend has sat at 18, 19 cents a share for quite a while. So the growth is low, but it is consistent. And so when you tie this dividend in with the price appreciation of this fund, I think you have a lot of potential for a really solid return and one that's not too risky. Now, I know you guys love the yieldmax funds, and I love the NEOS funds and the Roundhill funds that have these 40, 50, 60, 100% distribution rates or dividend yields. But this is consistent. This will make you money over time. There's no NAV erosion that we can see. We can track that data on our own, and they're just more trustworthy in my opinion. Now, am I going to buy some of these other funds? Of course I am, because they're super fun to own. It's super fun getting those dividends. But what keeps me sleeping well at night is knowing that I can trust some of these companies to perform as they have performed for years. And so I really think in the long run, both could do well. It just depends on your risk tolerance, and have some money in each. That's not financial advice, of course, but I hope you guys enjoyed this series of 3 monthly dividend stocks and ETFs and 1 quarterly, but all of which ones that I'm potentially going to buy more of or buy some for the first time. If you guys like this kind of content, don't forget to like the video and subscribe if you watched all the way to this point. I appreciate it, and I hope to see you in the next video.